and a very warm welcome to all the guests and panelists from around the world. Last I checked, I think we had folks from almost 24 countries and 4 continents which have dialed into it today. 400 people, equally split between coming in, or registered rather, equally split between between startups and VCs. As Rakesh mentioned, my name is Ike. I am the Vice President for Strategic Partnership in the Washington, D.C. area, and super excited to kick off the panel discussion today with our esteemed panelists. Let me start with Sim. Sim, as you're looking at the BDMI investments, would love to hear your thoughts on, in this COVID-19 age, in this pandemic, what are your portfolio companies doing to extend their runway? Any specific strategies that they're adopting? Anything you see split by verticals, maybe by industries? Would just love to hear your thoughts.
Sure. So obviously, this is a huge topic for many of our portfolio companies in March. And I think it's important to underscore the fact that even companies that were not hit immediately, so obviously, we are fortunate enough to not have a ton of sector-specific exposure. I think a lot of the portfolio companies were very careful in thinking about cash conservation through the second half of the year, given all the unknowns. Runway extension measures range everything from hiring freezes and in some cases layoffs where they made sense. A lot of discretionary spending was reduced. So everything from, as Rakesh was talking about with events, travel and events are often a big part of the marketing and sales efforts for many of my companies. So one of the fortunate byproducts was that sort of naturally has tailed off or became, of course, zero. And then, of course, a lot of the other, kind of considered purchases, I think folks look to cut. One of the things we encouraged our companies that were sort of in fundraising mode or had raised recent rounds was to consider taking additional money if available, even at the expense of further dilution. So, we had a couple of companies where, the rounds were targeted to be $10 or $12 million, but there was maybe a little bit more demand. And so in those cases, we actively pushed and were able to oversubscribe, leaving rounds open a little bit longer and things like that, just to make sure that they had more cushion. I think, and this is probably the most challenging area for portfolio companies to think about, it's that fear versus greed dynamic, where in some cases we've seen actually really strong tailwinds in the business, lower customer acquisition costs, better LTVs, better engagement. And so there's this temptation to accelerate investment. And in some cases, our portfolio companies are doing that. But at the same time, I think we've been very tempered, to sort of be careful. And so I think even though we have some companies that are actively hiring and growing, we certainly are, seeing a lot that have sort of slowed and are under hiring or underspending, even versus their newer revised budgets.
Got it. Sorry, one request I'm getting from the attendees, probably should have started with that, is I'll just quickly go around the room, maybe have folks give, say, 30 seconds to a 1-minute description of their fund, what the thesis is, where it's based, early stage versus late stage, geographies or verticals that you focus on, as well as their specific role in the fund. I completely forgot to start out with that. We'll go around and then we'll come back to Doba, because I do want to ask and I do want to keep the questions going. But Sim, if we could start with you, just a quick description of the fund and then your role in the fund.
Sure. So I'm a partner at Bertelsmann Digital Media Investments, which is one of the corporate venture funds for Bertelsmann, a global media company. We focus on digital media, enterprise software, fintech, and some other areas. Are a financially oriented investor, but we have a single LP, and look to make investments that are in areas where we have a competitive advantage. We're an early stage investor, so mostly Series A with some seed and some later stage investments. We are also an LP in some great funds, and we are based in New York, but cover the US, Europe, and Israel from a geographic perspective.
Got it. Doba, on to you. Quick
happy to jump in here. This will sound similar to Sim's intro. I am also a venture capital director for CareFirst, which is a larger corporate. For the people who are viewing this and are not part of the Eastern Seaboard, CareFirst is a health insurance company in the US. It is a member of the Blue Cross Blue Shield family. So we cover Blue Cross Blue Shield in Maryland, DC, and Northern Virginia with about 3.5 million lives under our umbrella. Within our operations, and I'll caveat this right away, I joined CareFirst about a month and a half ago to lead our venture capital efforts. So we're still very much in the construction phase of our portfolio and operations. But in terms of investment interests or opportunities, we will seek to write $2 to $4 million checks in Series A, B rounds, primarily as co-investors, not as leads, delivering clear strategic value. So at least in the US, the payer mindset, the health insurance mindset is a bit of a black box. We would like to help the companies we work with, on one hand, access this ecosystem and get a little bit more insight into how we operate, while at the same time, helping us improve the cost of care, quality of care, and access to care for our members. So this is who we are and what we fight for. Similar to Sim, once again, we also have a fund of funds allocation. So we're an LP in a couple of good funds and increasing that number every single day.
Got it. And that was one of the reasons I was so excited about the panel today, is that we have an even split between CVCs and institutional VCs. So it was great to see that contrast, especially in different verticals and how their portfolio companies are handling this pandemic issue that we're in. Logan, on to you. Quick intro.
Hi, I'm Logan Allen, founder and managing partner at Venture Capital. Launched the firm in 2018. We focus exclusively on fintech and exclusively on enterprise SaaS in the fintech world. We are all former entrepreneurs and corporate executives situated here in San Francisco, but invest in the US and Europe out of our flagship fund, which is early stage focused, seed through B entry points, check sizes ranging from 5. And then we have a regional fund in the Middle East and North Africa that we have launched through a joint venture with Venture Souk in Dubai. That fund is, again, early stage, but MENA headquartered companies. And we're in the process of launching a similar strategy and joint venture in Asia. So pretty wide ranging on the geo side. The fund strategies are largely early stage, but we also do some growth and late stage investing in de novo companies off of our co-investment platform, mostly Series C, D onwards. And our view of the world is very much enterprise SaaS oriented. And we've stuck to that disciplined approach and working with enterprise SaaS companies on business development and talent sourcing and bringing them growth capital as they scale. And I'm based here in lovely San Francisco.
Wonderful. And then finally, Hussein, on to you.
Yeah. So we're an early stage venture capital firm in London. I'm a partner. We're a small team, so I don't know what partner really means when you're a team of 3. You kind of do everything. And we write checks of between 1 and 5 million into fledgling companies that are starting from Europe, which hopefully end up expanding out to the US.
Good. So with that, let me get back to the Q&A portion of the discussion. Doba, onto you. Again, as you're looking as a CVC, when you're looking at your portfolio companies, I'm curious if you are encouraging any of them to look at non-traditional sources of funding. So obviously you have now, with the government programs, with PPP, and with everything else happening with COVID, you have the banks, the traditional debt, equity from VCs such as yourself. So other than the traditional sources, what are some of the non-traditional sources, whether it's the mothership that's your single LP, or what are the strategies that you have for your portfolio companies?
It's a fantastic question. I'll start copying out right away, right? The one thing I would say is, first and foremost, I don't even know what's traditional anymore, right? The past 3 to 4 months have been so crazy that, there have been traditional issuers of financing, such as debt holders, that have taken very untraditional measures to work with our companies. So I'll jump into that in a second. But also, it's a little bit of a unique experience on my end, since I switched firms in the middle of the pandemic, which meant that I saw some of it develop at my previous outfit, and now more of it develop at CareFirst. So with that, it will be a little bit of a mixed response. But let me jump back to the original point I made around just plainly debt. And I think that's a great example of a very classic instrument, right? We've used debt in some way, shape, or form in our portfolio companies forever. But I would argue that a lot of, perhaps all of our debt providers have been extremely responsive and flexible around the arrangement they have with our portfolio companies to make sure that, you know, the ship is staying pretty much steady. The reality is that this crisis has hit everybody. So nobody has an interest to extract a pound of flesh today if that would result in a good business struggling unnecessarily. So I would kind of challenge people who are, if you're viewing us today, to not think in the categories of traditional and non-traditional, but honestly engage anybody that they have a financing relationship with and figure out what they can go and structure in place to help them get through this. So whether it's debt, whether it's bridge rounds, right, and convertible notes to get them to the next stage. I think on our case as a large corporate, in the case of CareFirst, one thing that we have been advocating for our companies, and we try to lead the charge on it as well, is thinking about getting consumer financing. So customer cash is king, and in general, if you're able to finance your business based on advanced contracts or so on, that's generally a good thing. Some of our customers, right, of our portfolio companies have been hit by COVID, others not as much. And again, nobody wants to see a valuable provider struggling unnecessarily. We have certainly been open to discussing a more flexible arrangement, either in advancing some of our payments or in the cases where, you know, we're expecting certain returns, delaying those returns from our companies in a way to extend their runway. The final one you mentioned on there, and let's hit on the head, is the PPP program from the government. So I think that was a lifesaver when it came around, and you have to applaud the government for acting with unprecedented scale and determination in it. There's a lot to be ironed out. Our perspective there was that this was meant for companies that are truly in need. And, you know, it becomes a little bit murky if you say, well, you know, you're a startup venture, your runway was supposed to be 18 months, and now because of COVID, it's 12 months. Is that actually critical and realistic needs, right? Are you the actual target here of a support like this? And we've had a number of very deep engagements with our companies. Some of them have really been hit hard by this and have elected to take that financing opportunity. Others, realistically, you know, while they have not gone unscathed around it, decided that this is not critical for them right now, and the money is probably better spent elsewhere. So there's a degree of discretion on the side of the entrepreneur, the investors, and so on around this. But again, I'll wrap up the whole story with saying, these days, it has been a little bit of a rallying cry around the entire industry, whereas in the beginning, there was perhaps a scattering to go batten down the hatches and figure out, you know, who will survive and how do we keep our portfolio. I think more and more stakeholders have rallied to figure out creative solutions. So we've definitely tried to play our part in that.
Got it. And Logan, would love to get your thoughts on that. But before I go to you, just a quick housekeeping for our guests listening in. You can email your questions to events@kivitech.com. And the team will put it to the panelists. Please do say if the question is for one specific panelist or if it's a broader question to the entire panel. So Logan, would love to get your thoughts on what Doba mentioned. So Doba obviously coming in from the corporate VC background, focusing very much on healthcare. In your case, the institutional fund, looking very much at the fintech space. Again, non-traditional sources of revenues. What are you finding your companies, your portfolio companies doing?
Sure. So we're enterprise SaaS investors. And so our companies were a little more insulated in this environment. Thankfully, we really indexed away from SMB and consumer in our portfolio construction because we thought 2020, given the macro dynamics and given where we were in the cycle and the election year, which was already set up to be messy, we felt 2020 was going to be a pullback year. We obviously hadn't anticipated COVID and the severity and speed of that pullback. But had already tilted the portfolio significantly to enterprise SaaS companies who have multi-year contracts, tend to be mission critical type companies built-in price appreciation, the ability to get prepayment of their contracts up front at some level of discount to the customer, and to utilize CapEx versus OpEx dynamics and taking down that revenue. So there were a number of things that we did up front on the portfolio construction side. And then, I think Dova covered most of the structures on the funding side in terms of looking at convertible notes, insider, potentially flat price rounds or extensions of prior rounds and reopening those. And then thirdly, I would say another area we've seen, at least with one of our portfolio companies, and we've certainly seen it outside of our portfolio and the broader ecosystem, is a pivot, right? So businesses that may have been B2C oriented or had some level of consumer exposure, capital intensity, or balance sheet exposure, decided, okay, wow, I'm going to pivot my business and start licensing my technology to enterprise customers and really try to drive recurring revenue models. So we had a company that was set to be a vertically integrated insurer, realized how much capital they were going to need for that, abandoned that plan, and now have successfully pivoted into being an enterprise SaaS provider to other insurers. So I do think downturns create pivot opportunities, and some of them end up being not only saving graces for the company, but long-term far more beneficial. And then the other last point I make is we announced an investment today in Pipe.com. So Pipe is providing collateralized lending to SaaS companies, and they're creating a marketplace around that. So if you're a SaaS company and you don't want to wait 4 quarters or 8 quarters to receive the full contract value from your customers, you can use Pipe to effectively accrue that revenue upfront so that you can accelerate that revenue curve, reinvest it in growth, and not have to raise as much dilutive equity capital. So we think that's going to be a game-changing model for the enterprise space, and we're excited about what Pipe's building. But I think in these types of cycles, you have to stay nimble. Obviously, cost-cutting and being thoughtful on the OpEx side is hugely important. But we saw quite a bit of growth in our portfolio as a result of the enterprise SaaS tilt and an acceleration in digitization. Right, I think a lot of corporates in the pipeline of a number of our companies woke up and said, "Oh wow, this digitization thing that your companies have been pitching us on for so long, clearly important. We need to adopt this sooner rather than later." And it created this significant sense of urgency and a strategic imperative versus historically where it may have been viewed by the corporate or enterprise customers as a nice to have. So we think net COVID will have accelerated that digitization process, and coming out of COVID, the breadth and depth of the customer base in the enterprise and potentially in consumers as it relates to consumer adoption of digital banks is going to be really significant and a net positive. And so we're trying to be general optimists despite all the challenges on the political and the health side. We're hopeful that at least from a tech perspective, this will be for the best going forward.
Got it. So I'll put the next question to Hussein, but I definitely want to have thoughts from all of you on that. Before I do that, though, I'll put this link in our chat window for all the panelists and the attendees. It was a recent TechCrunch article announcing the successful second fundraise by Hoxton for $100 million. And then the incredible backstory with the Article 50 being triggered, all the challenges, and then obviously the successful fundraise. It also describes, and again, we'll come back to it, what the performance of fund number 1 has been. And so I definitely want to spend a little bit more time on that with you later, Hussein. But before I go there, would love to find out that for the new investments that you're making, or even the follow-on, how have the clauses changed in the term sheets that you're now considering? Specifically, are you making any changes? And again, feel free to divide it by, UK versus Europe, by verticals that you're seeing any changes, maybe for the better or for the worse, as far as industries go. I think that's a question we're getting very commonly from our own portfolio companies. So Hussein, I do want to start with you, but again, I definitely want to get the other panelists to weigh in on that too.
Yeah, I mean, we haven't seen very much in the way of changes. We've heard rumors of kind of the clause coming out because, you know, in a market where things change, you know, you find you end up with more structured financings, and if companies have hit kind of distress, but you know, then those kinds of things happen. But in general, we haven't seen it. We had one company that was in the travel industry that where revenues collapsed from 100 million a year, you know, down to, if we're lucky this year, we'll do somewhere between 10 and 15 million this year in revenue. So, you know, that's quite a correction, and that's understandable given that no one's really jumping on planes right now and going anywhere. You know, you would have thought if there was ever a time for a structured financing with, you know, multiple liquidation preferences and a down round and a ratchet and all the ugly stuff that usually comes up and came up in, you know, '01 and came up in '08, you know, that's where you would see it. And, you know, that was a flat round, simple extension. All the investors around the table kind of did their pro rata on the investor side and extended out the runway until the beginning of, you know, 2022. So, you know, give it enough time to get out of harm's way. I think the one lens that we're seeing, and we've been reasonably active on the investing side, even despite the pandemic, you know, as a small firm that, you know, believes in technology, I think we figured out how to start doing this stuff over Zoom and over kind of virtual. So we've been writing checks. You know, the one thing that we're consistently telling our companies, and almost every firm that we know is kind of saying the same thing, is you want to get as much of 2020 in the bag as possible. You want to get as much of 2021, if not all of 2021 in the bag. You really don't want to be in a place, you do not want to be in a place where you're fundraising or have to fundraise sometime in 2020 or 2021. So you want to delay that fundraising. So you want as much runway as possible. Now, some of that responsibility goes back to the company to kind of keep costs on the lower side and to be careful and be judicious about what it's spending. And some of it falls on the investor responsibility, which is to make sure the companies are well enough capitalized that they're kind of out of harm's way, both this year and next year with all the economic uncertainty. And you know, despite all of the economic uncertainty, if you take a look at the stock market today, you know, it's doing quite well. If you look at, you know, just before this call, I was one of our companies is in the consumer marketplace business. I was pulling up Etsy's comps. You know, Etsy's trading at like 12 times revenue right now, which is up from where it was in Q1, which was like 6 times revenue. So, you know, these are high multiples for businesses. I think there is a flight to quality in the market, but the market has also been very rewarding towards those companies that are at the top 1%. So if you're investing in companies that are going to be the future top 1%, and I would question if you're investing in something that you don't think is going to be the top 1%, why are you writing the check as a venture capitalist? Because there's no return in the bottom 99% anyway, which we all know. If you're investing in the best in class, you know, there are other people who want to do this as well, and you end up still paying up given kind of where the public market comps are. So, but I do think you end up having to think about this runway issue a little bit more carefully versus terms or structure.
Got it. So, Sim, if I can put the same question to you, looking at it from a CVC side, obviously an American side, and then from the media world, you know, similar points of view, it's the same when it comes to term sheets, how those are changing as far as clauses go, or what are your thoughts?
Yeah, I mean, when this all hit, we were certainly expecting to see relapses of 2008, 2009, you know, the structure, the down rounds, or, you know, warrant coverages. And candidly, we've seen them, but it's generally been in troubled businesses, right? So there was probably a notion that there were, you know, weaker companies getting buoyed by the influx of capital, which there's certainly been capital sources that were available in 2019 that are not around in 2020. A lot of the so-called tourists in the industry have tended to pull back. A lot of the high net worth individuals and family offices and many of the corporates that have been challenged by COVID or for other reasons have certainly pulled back on investing. And so I think for many of the sort of companies that we would consider future top 1%, the terms really haven't changed from an economic perspective, except the fact that if you were going to raise 2020 money now and 2021 money next year, you're probably going to try to raise both years runway as soon as possible and take the extra dilution. The stuff that's changed otherwise is, there's certainly things, investors are asking questions about the PPP program, which obviously if folks on the call aren't aware of, happy to talk more about it. But that was a very big question around how investors and future acquirers will perceive taking the loan. And then also, of course, there's things like force majeure clauses in term sheets, things that you might not have contemplated, obviously, or concerns that folks are trying to mitigate through paper. But by and large, the economics that we see in don't really look like 2009 all that much.
Got it. So, Doba, I'm curious, healthcare stocks, healthcare startups, same point of view, completely opposite.
Very similar, yeah. I hope I'm not an example of herd mentality here, but I'll echo you saying that one thing that took us by surprise is how this played out. We were ready to see the play out on 01, 08, right? And the easiest way to think about it, if you know nothing about this space, is private multiples tend to trail public multiples by about a quarter. That's roughly what you would observe in these markets. And I think the crisis hit, we tried to support our companies and waited to see where things will go on the valuation side. And the public markets did a quick V-shape and are back to where they are today, which is honestly still kind of surprising. So the reality is, yeah, we're not seeing much of a change these days, but also there is a secondary feeling that this is still playing out. Like we are not out of the woods yet. And we're trying to figure out how this will end up looking. One interesting counterpoint I'll take to Sim's example is definitely there are more challenges for the companies that were heavier hit by COVID. There's an interesting challenge on the other side for the portfolio companies that actually did very well because of COVID. And I won't use a real example. I will use a fictitious one. Let's say you were manufacturing very high-tech respirators with air filtration quality for this hit, right? Suddenly, in February compared to, March of this year, your revenue jumped 10, 20, 50 times easily, right? Because you played smack in the middle of the crisis. And of course, many of those companies are using that momentum to go out and capitalize, figure out how they can get more cash in the door and support their extended growth. The question then becomes, okay, how do you value this, right? Normal multiples don't really apply because this is to an extent idiosyncratic related to COVID, but maybe we are in a COVID environment for the next 10 years, maybe in a COVID environment for the next 6 months. So I'd be very curious to hear how about the rest of the guys think about this. We've had perhaps more challenge thinking with and valuing rocket ships, people who are riding the, let's say, demand that COVID has generated, more than people who have struggled with the current economic cycle, because with them, at least more or less where the bottom is.
Got it. So going from healthcare to fintech, Logan, I know you and I spoke, you and Rakesh spoke about, I think, a month ago. It seems things are fairly even since then, but I'm curious, when you look at the world of fintech and term sheets, what are you seeing?
Sure. So I'd echo everybody else's comments. This is definitely not 2009, where you're seeing a significant number of recaps and cram down rounds and so forth. I would say, by and large, it's been either insider rounds that are reopening of a prior round or some kind of convertible note to sustain the company. And then two, for those companies that are truly outpacing and growing extremely quickly, we're actually seeing further investment. So we have a company called Natomi that's an AI machine learning business for customer service. And as you can imagine, nobody's going into call centers. And so that business has just been growing exponentially in the midst of COVID. And so we stepped up, and this will be a deal that will be announced in the coming weeks. And approach the company on doing a preemptive round. And I think we're trying to be opportunistic with businesses like that have clearly been advantaged in this environment, and we believe will grow dramatically coming out of COVID as a result of the acceleration in digitization that I mentioned earlier. And then I would say on the consumer and SMB side, particularly in the public markets, you're seeing companies like OnDeck and Lending Club trading at fractions of book value. And I think that, has been a long time coming. I think Sim made the point that, there's a number of companies, this is kind of the waters receding, so to speak, on a number of business models that were very difficult to scale in good times. And COVID just shined a light on the fact that, their unit economics and the sustainability of those models, without everything going up and to the right and access to capital being expensive, that they would be long-term problematic and will likely go to zero in the public markets as part of this shakeout. And I think the same thing can be said in the more capital-intensive business models on the consumer and SMB side in the private markets as well. And so you've seen some recaps or some down rounds as part of that dynamic.
Got it. So I love the caution that Doba threw out there that, hey guys, I don't want to be part of the herd mentality, but, and so I want to push all of you a little bit more on that, because one consistent theme I'm finding across the answers is that, well, so far we are not in the 2008, 2009 timeframe. So let me start again with Hussein. And okay, so far we are not. If you look at the next 6 to 12 months out, is this a false recovery that we're in so far? Do you expect things to get better, same, worse? And therefore, how do you expect the term sheets to change as you look forward into the future? I know they've not so far, but if you had a crystal ball, what would you say?
So we don't have a crystal ball, unfortunately. So we have kind of two phenomena happening, I think, in the world. So one is we have this global pandemic, which is, I think, both a demand-led shock as well as a supply-led shock. We're just about to close another healthcare type deal or a health tech type deal. And every bit of conversation I've had with like very senior people in the NHS is there's going to be a wave 2 and there might even be a wave 3. And so this is probably here to stay. I don't believe that the Oxford or the Moderna kind of vaccines, I know there are like 100 plus things are out in the market are gonna cure everything anytime soon. So I think this is going to stay. So, and I don't think people have reconciled the kind of economic malaise that's going to come with this in both a demand and a supply-led kind of shock type system. You have unemployment in the U.S. in the 30 million plus range. You're gonna 30% of people aren't paying their rent right now, right? I don't think we have phenomenal leadership either at the federal level or the state level dealing with this in the U.S. So let's actually see what works out. At the same time, and this has been true now for about 10 years. We've turned on our printing presses in the US. And so you have an overabundance of supply of capital that has virtually no access to yield almost anywhere in the world. And so when you have an overabundance of, it goes back to microeconomics, when you have an overabundance of supply, overabundance of demand, and there's almost no supply, and supply being like interesting places to get yield, you have a mismatch and prices go up. And I think that's largely the nature of the stock market right now, which is why the interesting companies are getting massively bid up. And you're seeing even from Q1 to Q2, like a big change in price. It is not fundamental driven. It is not a value investment type of business at this point. It is simply a mismatch of supply and supply of capital or supply of inventory and demand of capital. And so I don't know how these two things reconcile. I think if you do end up in a protracted economic kind of situation, whether it's a recession or whether it's a swoosh or it's a U-shaped type of economy, or it's neither of those things, and it's a protracted kind of recession, and you just have too much money in the world. I don't know how those two things are going to fit next to each other. I'm not a macroeconomist, so it's really hard for me to figure out. I think we have the luxury of being venture people where we have to play towards market, but a lot of our alpha that gets generated is on absolute growth. And so when I invest in a company and it's doing $1 million of sales and it goes to 200 million of sales, I'm kind of in the money as long as this macro stuff kind of loosely figures itself out. Even if we're in kind of bad times, I still think I'm kind of in the money. It's probably not the price that I'm paying at my $1 million round when I'm exiting when it's 200 million. So assuming I can exit. So I don't think I'm smart enough to answer the question. Is the short answer.
I'll
No,
add.
love the humility. And so we have a ton of questions coming in. So again, I do want to stick to the topic, but say under a minute, crystal ball, 6 to 12 months out. What are you guys seeing? And I'll go to Sim.
Yeah, sure. My point was actually going to be, I don't, as VCs, particularly early stage, we're not looking 12 to 18 months out. We're looking 3 to 5 years out. We certainly think in shorter terms in terms of execution and access to capital, but we're playing to where we think the market and the demand is going to be. And so, as I said, we're trying to be super conservative, plan for the worst, hope for better than the worst. The other thing I would offer, which may be a nearer term impact, is that we've seen a massive shift in value creation because of how cheap software has gotten, how cheap infrastructure has gotten, right? All the API-led innovation, all the innovation from technologies and investments that used to take companies built on Stripe, built on Shopify to execute quickly. I think we're at a really exciting time now that companies are more virtual. Our companies in New York and Silicon Valley and London were limited by their access to capital because they were hiring engineers and hiring talent in very expensive cities with a very small percentage of the world's population. So I'm actually quite bullish, at least at the early stage, on companies, even with more limited resources, to actually get more done faster because they're now tapping pools of talent across the world.
Got it. Doba, if I can put that to you, if you're looking at term sheets, again, term sheets next 6 to 12 months, what do you think? Getting better, getting worse, more investor friendly, less investor friendly? What do you think?
I think they have to get more investor friendly, and that's based on a similar answer to what we've heard so far. But here's the reality. I've lived through one hyperinflation period in my life. That's a very dubious pleasure to have survived, clearly in Europe. So the reality is we need to be more cautious. I'll tell you the healthcare perspective. At CareFirst, we're here to serve our members, right? We are the nexus of social, economic, and health impacts. And reality is, if the genie gets out of the bottle, we'll be hit with all three of them. As you mentioned, we're already seeing massive issues around unemployment and people losing insurance, right? They're coupled with the healthcare crisis. We cannot ignore that fact. So I have to throw out all my high school economics out the window, because what I've been taught is that the Fed cannot sustainably maintain a $7 trillion balance sheet. Here they are, right? And I guess maybe that's possible. The optimist in me wants to believe that we'll be able to get out of this relatively unscathed. The pessimist is preparing for the worst, and that will get reflected in real terms.
Got it. Logan, I'll go on to you for the same question, and then there's another question that came in through email. So I'm going to put that to you as well as Sim, because the TechCrunch article that I posted did address that for Hussein. But for the two of you, have you closed any deals virtually in the last, say, 3 months that this pandemic has been happening? So I'll go, Logan, to you first.
Yeah, so surprisingly, we've made 7 investments since March 1st.
Wow.
So thank you. Yeah, it's been insanely busy, busier than ever, candidly. 6 of those companies we met, and many of them were follow-on. So, and then the 7th, we actually never met. It was all Zoom calls, and that was Pipe, who I mentioned earlier and got announced today. So we led 3 of those rounds. One was a follow-on round that we led, and then 2 were net new investments that we also led. So it's been a bit surreal, but we take a thesis-driven approach to what we're looking for, and had been, analyzing these theses and the different players that represented them for some time. And so we just happened to get conviction during this time period. But obviously the nature of the diligence, particularly for the traditional in-person and on-site meetings, changed. But the aspects of our modeling and valuation work and so forth did not. And we were able to get comfortable and make offers in this environment. I would say that we preempted 2 of those rounds, just based on the growth curve that we saw in the company and how they were growing in COVID and how we expected them to continue accelerating out of COVID. We think the second half of the year is going to be far more interesting from a funding and investment perspective, and hopefully a growth standpoint as things reopen. I actually think Europe and Asia are going to reopen more quickly than the U.S. just because of how poorly we've handled COVID writ large in the shutdown.
Yep.
And so, we're hopeful for our European and Asia relationships and investments that those will accelerate and come out of this experience more quickly. But yeah, no, we've made several investment announcements. There's going to be several more this month, and it's been hugely busy. But it's again a result of this increased digitization and adoption curve that we've been seeing across the enterprise landscape, and a realization that they need to move quickly in adopting these companies versus letting them sit and doing a POC. The commercialization aspects have only accelerated, which has been exciting to see on the enterprise side.
Got it. Tim, any deals done completely virtually in this age of pandemic in the last 2 to 3 months?
Oh, sorry. For us, actually, we've closed several deals since the pandemic started, but they were all teams that we had met, either starting the process pre-pandemic or having looked at the company previously and revisited them during it. We've definitely slowed down investment pace and kind of raised our bar in terms of new deals through the current cycle.
Got it. Okay. Good. Sorry, Hussein, did you have any thoughts?
Yeah, we did, not including follow-ons, we did five ones, 2 of which we started kind of pre-March 1st, and then 3 of which we kind of did almost entirely virtually.
Got it. Good. Coming back to Doba. So I know you've only been in the new role for, I think you mentioned, less than 2 months. But I'm curious, in that time, between seed, Series A, Series B, anything that you're going to be seeing becoming more interesting over the next 3 to 6 months, where you are going to be putting in capital, or any preference? Any preference that might be changing or not really?
Yep. So we're actually going to run a fairly tight portfolio strategy. As I mentioned, the ideal target for us is deploying probably $2 to $4 million as a co-investors in Series A, B companies, taking 20 to 30% of the round and just being a good strategic partner, right? The reality is that there's a very clear value exchange that I at least see from our side. So payers are opaque, so we can help you navigate that space. We have a pretty good Rolodex of payers and providers. More than anything else, we are quite close with a number of providers in our area, and therefore that's an opportunity to drive a little bit more business. And finally, on that level, we're very interested in driving commercial contracts to our investments, because the reality is it's a little bit backward, right? We're investing in companies we want to work with, not the other way around. So for us, the value comes from having some more innovative, faster growing, forward-thinking entities drag us into the future. So that is roughly where we are targeting our efforts. Always happy to talk to earlier stage company, but the reality is, our procurement department still asks if you have $500,000 cybersecurity insurance. I don't know a single seed stage company that has that, right? So we're a little bit better equipped internally to work with more mature companies, and that's the sandbox we're gonna carve out for ourselves. So I'll answer the question from the previous round, which is, we've done one follow-on because we have a legacy portfolio in place, right? And we are currently diligencing one fund investment. So, I've got to, applaud my colleagues who are doing much more on the virtual investment side, but we're not sitting still either.
Got it. No, fantastic insights, Doba. Thank you for that. Logan, you mentioned something in our conversation last month, actually earlier this month, and then you mentioned a little bit again in terms of your fund looking at companies in the Far East, in the Middle East, and then you mentioned a little bit earlier how obviously the policy response has been very different in some of those regions. So you see them coming out maybe faster, better. Could you expand on that a little bit more in terms of your U.S. investments versus overseas investments? again,
Sure.
do you see,
Yeah.
their customer base changing? Do you see them being able to close bigger rounds? Would love to hear more.
So the way we approach different geographies is that I've spent a lot of my career and grew up in Europe and the US. And so as have other members of our team. So we feel very confident in investing in the US and Europe, although even in Europe, we like to have local partners on the ground who are already in the investment or can help us syndicate. And so our approach to other regions is to joint venture and co-GP our strategies. And so in MENA, we've developed a co-GP relationship with VentureSouk, who's a very seasoned manager based in Dubai and have offices in Riyadh as well. And we've launched a MENA-focused fintech fund that will focus on seed and Series A entry points and MENA headquartered businesses. And similarly, as I mentioned, we're looking at another joint venture in Asia that will focus on China and Southeast Asia-based fintech businesses. We just think having local team on the ground with local knowledge, understanding of the cultural intricacies of those investments, and then being able to actually add operating value locally is hugely important. While I traditionally travel to the Middle East 2 to 3 times a year and to Asia 2 to 3 times a year, that is currently not possible. So I'm more grateful than ever for our local partners. And so that's been our approach to local investments. And what we've also done as a firm is developed a view on geographic maturity curves. And in the fintech world, they actually follow a very similar line in moving from infrastructure, things like cloud, core banking systems, accounting systems, and so forth, up to payments, to lending, to wealth management, to asset management, to insurance, to blockchain, to platforms. And so we've developed this proprietary framework for how we view different regional maturity curves. And the MENA region is at an inflection point where we feel there's strong merit to be looking at early stage fintech companies. And then further to the point you made, the regulators, particularly in Abu Dhabi, with the Abu Dhabi Global Markets and in Saudi with their regulator and in Bahrain, have been very supportive of sandboxes and open banking. And very much open to the regulatory rules around fintechs and allowing them to compete with incumbents. Actually, in some cases, even more open than the US as far as experimentation and integration with the regulators is concerned. So we see that as an inflection point, as we have with Singapore as another example. And we think that merits a dedicated strategy. We would much rather do that in different funds, having regional funds and then a flagship fund that is more focused on the US and Europe, so that LPs know exactly what they're getting themselves into from an exposure standpoint. We can be very clear to the market and our entrepreneurs that we're talking to about where we're investing and how we're investing. And then we can have local expertise, both on the investment decision-making side and on the value-added side. Because if you're an entrepreneur and you're an exceptional one, capital is for sure a commodity, and you're looking for a lot more from your VCs than just a check. And so we want to be able to provide business development, talent sourcing, access to downstream capital, regulatory and legal expertise, and so forth.
Got it. So I want to come to Hussein now, and I'm pulling up the TechCrunch article. And there's one line in that article which definitely got my interest, and so I have a two-part question around that. This is a line where it says the firm's portfolio is currently valued at more than $7 billion in aggregate, while Hoxton's first fund has the highest ratio of unicorns to investments, according to Dealroom. So my question is, Hussein, one, what is the secret sauce? And two, can you give that to us?
Yeah, I mean, I think a lot of life and a lot of success is showing up at the right place at the right time. So we set up our fund at a time when nobody really wanted to invest in Europe. I'd like to think we're smart, but to be quite honest, when no one else wants to do something and you kind of turn up and are willing to do something, things are going to come and line up at your door. And, you know, we were reasonably well trained, I would argue, having peeled out of bigger funds to not be incompetent at our jobs, and then being in the right place at the right time, kind of plus a little bit of competence, I think meant that we had a decent strike rate. So we did 17 investments out of that first fund, and, you know, 3 of them turned out to be pretty big. And I think we're going to end up with a 4th and a 5th that same way.
Nice. And then you're going to email the secret sauce to us after the.
Well, the secret sauce is being in the right place at the right time. So, you know,
That's hard to
it was
copy. Yeah.
it was pretty obvious that Europe was going to develop in terms of a tech economy. I mean, that wasn't rocket science. And I think the challenge is everyone got burned in the early part of the 2000s or the late 90s. So people are very skeptical. But if you paid attention to what was actually happening on the ground, then you realize that the world was globalizing and the tech distribution platforms are global, whether they're Google or Facebook or the App Store, et cetera. It was not rocket science to say, hey, something interesting might pop out of the UK or out of Germany or out of Paris. It's just a matter of time.
Got it. Now, the same article mentioned that 1/6 of the new investments so far were made after the start of the coronavirus crisis. So if you could just break that out for us, that which specific sectors did you go long in, you know, that you are hopeful is going to take off, which ones maybe that you stayed away from, you know, would love to learn that mix.
Yeah, so from a sector perspective, we're deliberately anti-thematic. I mean, we genuinely don't believe that we can figure out where the next big thing is going to come from. Quite honestly, if we really had any inkling of where the next big thing was going to come from, we wouldn't invest in it. We would just go off and found it, because I'd much rather own, you know, 50 to 80% of a business than own like 10 to 20% of a business where I have to share the carry with, you know, or share the profit and only get a carried interest in the profit that I would generate. So we're anti-thematic, but I would say, you know, these days about a 5th, maybe a 6th of our fund is kind of health meets tech. It's kind of a new market. It's everything from kind of diagnostics to AI, and probably about another 5th is kind of deep tech. It's like robotics and, you know, and we have a next generation enzyme company that you know knows how to synthesize an enzyme from scratch using DNA. So, you know, very much more exotic stuff where I am not capable on the science side to even be able to really follow the logic, but I can understand why the pieces might fit together. And then a 6th of our fund, which is five deals, have been done in this kind of COVID timeframe. And we didn't know that we were going to do 5 deals, and we quite honestly didn't know what they were going to be, and they're all pretty eclectic in terms of what they are. It's just the right things kind of walked in. We're well enough trained to ask the right kinds of questions to understand that, you know, these are interesting new markets, and our belief is if they're funded well from today, they can probably ride out the immediate short-term storm that we think is, you know, the rest of 2020. And they've got to, you know, they're building, right? So they're not selling. So that's 2 years before they're kind of in selling cycles. So we're kind of optimistic about our companies. And like with all early stage investing, we kind of have to say a little prayer and hope it works out for the best the way it did the first time around.
Got it. We're coming up on time. So one common question that seems to be coming across, and would love to have all of you maybe take 15 to 30 seconds on that and address it, is how do the startups get in touch with you? So let me start with Hussein, and then go on to Sim, Logan, and then Doba. Just directly on your website, email you. What's the best way to get in touch with you?
Yeah, we have our emails on the website. LinkedIn is easy. You know, email is really easy. It's first name at hoxton.vc.
Okay. Sim?
Sim at bdmifund.com. Mention that you saw me on this panel, and happy to learn more and respond.
Perfect. Logan?
I've been getting a lot of LinkedIn inbound in real time here. So LinkedIn is okay, but I get hundreds of messages a day on there. So better just to send our whole team an email if you're interested in connecting with us. It's just info@finvc.co, which is on our website, finvc.co, and you can see more about our investment box. We're pretty specific about what we're looking to invest in, but always eager to connect with great entrepreneurs. So looking forward to hearing from everybody who's participated. And it was a lot of fun spending time with everybody on this call.
Dova?
And on our side, our website's still being built, so patience. So I'll do the opposite of Logan. Hit me up on LinkedIn. I think there's 2 Dovas, me and a dropshipping company. So I'm the not dropshipping company.
All right. Well, that's a good way to tell. So with that, we're up on time. Thank you to all our panelists for those super insightful comments and remarks.